Hi, this is Mr. Yeung of Admiral Investment. Over the past 3 weeks, we have discussed the basic features of REITs through this channel. In the next several weeks, we will go one step further and discuss the concepts that evaluate the quality of an individual REIT. Before we go further, however, let me summarize what we have covered so far. You can find the link to the playlist to the first 9 episodes of this primer in the annotation right next to me. In the previous episodes, we discussed that since 2000, REIT legislation has been adopted by different Asian countries. REITs are a type of commercial real estate investment with a stable dividend payout. The dividend grows through cycle, and this may lead to capital growth over the medium term. The REIT structure has 3 characteristics. REITs are required to mainly hold rental properties, which typically have multi-year leases. REITs are also required to pay out most of its net income to unit holders in the form of a dividend. REITs are more transparent than developers and rental stocks. Through cycles, REITs can typically raise rents and generate alpha through management strategies. This may raise dividend levels and eventually the stock price. Most types of commercial real estate, including REITs, are commonly thought of as an inflation hedge. Over time, actual growth is correlated to inflation. When interest rates are increasing, the economy is typically doing well. And when the economy is doing well, rents tend to increase. REITs in turn can grow their income and dividend, and this may lead to stock price appreciation in the long run. REITs have stable dividend payout. They serve as inflation hedges, and they have rental upside in a rising interest rate environment. As a result, traditionally, institutional investors who have a need for asset liability management are some of the key investors of REITs. As of 2014, there are about 130 REITs in Asia Pacific, and this leads to the emergence of Asia Pacific regional REIT funds. An Asia Pacific REIT portfolio typically buys REITs from 3 economic blocs: the Asia Pacific OECD countries, Greater China, and the ASEAN countries. A REIT fund enjoys diversification, which in turn mitigates risk for investors for a higher risk-adjusted return. We have data showing that the correlation between Asia Pacific real estate markets is low to medium. Investing in these markets at the same time, therefore, lowers the overall risk level. This REIT primer has been recorded in English and Cantonese, and we have provided a version with Mandarin voiceover. The playlists of all 3 versions are available in the links next to me. We will also list the links below. If you like our video, please show your support by subscribing to our channel. This means a lot to us. The link next to me will bring you to the subscription screen, and you can also find the information below. The REIT primer is also available as a printed document. Please visit our corporate website in the link below. In the next video, I will be discussing our plans for the next few episodes of this primer.